let's bring in David Marshall, Senior Asia Banks Analyst for CreditSights Singapore, joining us this morning. David, good Monday to you. First off, let's talk about China, shall we? Since we came off the lending numbers that we got over the weekend. Hit pretty hard, 2011. What kind of year will it be for 2012?
Well, China, as you know, has been through a sort of turbulent period over the last few years. We had the tremendous loan growth 2009 and 2010, and then last year the authorities were really clamping down on credit growth to ease those inflationary pressures in China, and of course that's put pressure on the property market. I think we have now reached a turning point for China. From a fundamental perspective, if I put my sort of equity analyst hat on, I've always been skeptical about the Chinese banks, because after all they are government owned and under the control of the Communist Party. So they have broader political objectives. But I think this year what those objectives are to ensure, as you said before, economic growth, stable economic growth. So, I know people are worried about the hard landing and concerns for the property market, and we share some of those. But at the end of the day, it seems to me the Chinese government, the Communist Party, has no interest in bringing about, a crash when what they really want is stable growth and full employment. And particularly when they control the economic levers, the fiscal policy, monetary policy. They even have control over the banks, of course, to a greater extent than in other economies. So the key issue is, will they use those levers wisely to ensure that growth will, not decelerate too much? And my guess is that they probably will. And that means in practice probably we'll see a relaxation of credit growth, more credit growth for the Chinese banks next year.
Yeah, I'm sure no government official wants to bring about a crash in anyone's economy. Okay, David, so can you make a comparison here? How do Chinese banks stack up this year versus, say, the Korean lenders, which have also been hit pretty hard in 2011? Singapore lenders deemed pretty safe. Australia as well, you got to throw that in.
Yes, as we mentioned, the Chinese banks have certainly fallen to very low valuations. And while I have that fundamental concern, from a longer-term perspective, it wouldn't be at all surprising to see a bounce back by those Chinese bank shares once people see that the government is going to take necessary action to keep the economy growing. And that, in turn, should be quite helpful for the region. The Korean banks, for example, from both an equity and a credit perspective, I think are reasonably attractive. They trade at below sort of book values. And the Korean economy, of course, is exposed to regional growth. So if we were to see signs that China's growth is going to remain reasonably robust, that will be helpful, really, for the broader region. I mean, Australia, of course, in particular, would be a beneficiary. But, we can't get away from the fact that, Asian economies have slowed down. I mean, we've had a tremendous run for regional banks, particularly Singapore and Hong Kong. Their revenue growth is certainly going to slow. And, of course, while cost pressures remain, it's going to be tough for them to achieve much in the way of profit growth, this year. So definitely a much more sluggish environment. But from a fundamental perspective, most Asian banking systems are still in reasonably good shape. NPL ratios are low, so no real sort of problems, I think, certainly compared to what we see in the Eurozone. I think it is true to say that most Asian banking systems are a relatively safe haven.
Okay, so while Chinese banks may see a catch-up year in 2012, you're saying Japanese banks remain weak and will remain weak for this next 12 months.
Well, the Japanese do pose an analytical challenge. I mean, I have to say they are doing quite well at the moment. I mean, fundamentally, the profitability of the Japanese banks is very weak because of their extremely thin interest margins, lack of diversification. They are, of course, trying to sort of rectify that partly by expanding into Asia. But I think the scale on which they're doing that is not really going to materially affect their profitability, in the near term. No, they are performing quite well. And if the Japanese economy picks up this year, their near-term outlook might be quite decent, in fact, in terms of earnings. But, the big issue hanging over them that always concerns me is that these big banks have, because of the lack of lending opportunities in Japan, have invested huge amounts in Japanese government bonds. And so, I just worry that at some point people might look at the Eurozone crisis and ask, well, given that Japan has an even higher fiscal debt burden than any of the Eurozone countries, sort of people might start to question Japan's fiscal position.
That's a good question, though, David. Let me just get your thoughts on the news story coming through that the banks might be able to go below the Basel Committee, the minimum liquidity levels in a crisis. Do you think that has any impact on the industry itself?
Well, I think for Asia, since most banks are fairly liquid, I don't think in practice it's going to be a major issue. It's an interesting one, isn't it? That in some ways it's very pragmatic. I mean, after all, it would be rather odd if regulators were to force banks effectively into a default, that they couldn't pay out on maturing obligations, even though they had the cash or liquid assets to do it, because the regulators are saying you must maintain those liquid assets. At some point, of course, it makes sense to run down that liquidity in order to make sure they can pay the maturing obligations. But it really depends how they handle it. You know, the regulators mustn't ease up too soon, otherwise banks will run out of money. And of course, no bank wants to put their hand up and admit, hey, we're in a crisis situation.
That's a good point. David, thanks for talking to us on this Monday morning. Have a good week. David.